welcome. I'm pleased to have both Fischer, former Fed insiders, because we're going to get the full scoop, because neither of them are on the Fed or bound by their communications policies anymore. So this is exciting. And just to review the years here, so Stanley Fischer joined the Federal Reserve as vice chairman in 2014 through 2017. Richard Fischer joined 2005 to 2015. Our current Fed chairman was governor from 2012. So you both worked with him, you both know him. Stan, tell us about Chairman Jay Powell, something we don't know.
Well, Jay is the sort of person you'd like to have as chair of the Fed. He's very calm. He knows a lot. He doesn't show off. And he will, my guess is, will surprise us on the upside because he is duly modest about a lot of things, more so than is necessary. I think I would like to say a word in favor of the administration before I get going, which is they have appointed so far a very good team to the Fed. And I don't think you see much politics in what's going on in the appointments to the Federal Reserve Board. And that was a concern, and it no longer needs to be a concern. So that's a very good thing, and Jay will handle that well. Plus you didn't ask me about this, but if I may.
Please.
Appointing John Williams as head of the New York Fed is a very good idea. He's a very good economist.
And Rich Clarida replaces you.
And Richard Clarida is
How do you replace God?
It's hard.
Oh,
impossible.
Big shoes to fill.
All right, Moses.
So you know, Richard.
Well, about how to replace God, they found a successor to him.
Richard, you know Jay Powell pretty well. What's interesting is actually he has no formal economic training, not a PhD economist like yourself, unlike Dr. Fischer.
Again, but I think that's important actually in this case. He understands capital markets. He came up through that channel, understands credit. Remember, Paul Volcker did not have a PhD in economics. He came up through the Chase and the credit side under Robert Rosa and David Rockefeller actually. But here's the little secret about Jay. I can never get him to drink more than one glass of wine when we have dinner. He's about as moderate, Stan, and level-headed as you could possibly be. And I agree with Stan, you couldn't have a better person in this position today. And I remember his first meeting, which was June of 2012, he warned us that we were taking volatility out of the system and that eventually it will return. So I think he's a little more comfortable with this. He expected it. And we haven't gotten abnormal volatility, but we're back to some norms. And I don't think it dissuades them from pursuing the path of policy. And I want to double down on Stan's comment. John Williams, who I had the pleasure of being with almost my entire time there, he succeeded Janet at the San Francisco Fed, is really a perfect choice for two reasons. One is he's a brilliant economist, and he's going to bring a lot to the table. Remember, the vice chair of the FOMC is the president of the New York Fed, so he gets the penultimate word at the table. And the other good thing for John is he's moving from the second most expensive city in America to the most expensive city in America, so he can afford to be here.
Into New York.
Good guy.
Tell us a little bit about that table. What happens inside those Fed meetings? Stan, how heated does it get when it comes to making monetary policy?
Well, my guess is, based purely on hearsay, that it is much less heated than it would have been before they published the transcripts within 5 years of the meeting. And you are aware that what you say is going to be read by millions, perhaps. And so people come with prepared speeches, and they deliver them, and it's all very serious, and it doesn't get heated. There are sometimes exchanges between particular people who've been friends for a long time and things like that, which are funny, and, you know, underneath the fun, there's a needle.
That's Richard, right?
I'm not sure about it. Richard,
Who did you fight with the most at the Fed?
Richard was unique, so I'm not sure how to describe his style, but it was always a pleasure to listen to him. That much was sure. I suspect that the decision to publish verbatim transcripts within 5 years has made a huge difference. And the other fact which you should know is a majority of the board cannot meet and discuss anything related to economics without it's being declared a formal meeting of the board and minutes being taken. So now that there are 3 of them, now are there 4, are they again?
3.
Waiting for confirmation.
They can meet whenever they want.
No, they can't because
3 out of 7, isn't it?
you need somebody to take the minutes.
Oh, that's true. That's right.
So you can't sit around a table.
Are you breaking did you break some Fed rules?
Richard, yes, you must have broken the rules.
Well, I was not part of that inner crowd, but this is an important point that Stan makes. They aren't heated conversations. The level of intellectual discourse, of course, I don't have a PhD in economics, always was just fantastic. And I do think the fact that someone's going to read your transcripts, now millions will read yours, maybe my children will read mine, I'm not quite sure, but I was always mindful of the fact that someone will read this eventually. I don't want to look like an idiot. And I want to put a good joke in there every now and then. But it's a very civilized conversation. And the press likes to make it sound like it's combative. It's not. It's a group of people doing their level best to get it right. And they come from different perspectives.
Richard, is Jay Powell a hawk or a dove?
I don't like that nomenclature.
I think you've called yourself a hawk.
Well, I was a hawk because doves come from the pigeon family, and I don't want to be anybody's pigeon. So, but I think he's a pragmatist. And I never liked, in that aviary that they put us in, I never liked that ornithological distinction.
No, I think
wise owl.
That's,
this is the wise owl.
Listen, I think, I'm not an ornithologist or anything, but I think owls have some dirty habits. And,
eating mice, for example.
I wouldn't accuse Jay of being in the least bit dirty on anything. I disagree on, yes, it's very valuable that the transcripts be published. When I was in the Bank of Israel and we introduced the transcript notion with a new constitution, one of the guys said, well, how can I face my grandchildren if they're going to read this? Well, 25 years later, you can probably say I was younger then or something like that and less wise than you are today. But 5 years means you may still be on the board when it's published.
That's right.
And I didn't find that very useful. And the word among the people there is that the quality of the discussion declined, or at least the intensity declined with that decision to publish the transcript so quickly. And the whole setup is kind of anti what I think a committee should be like, where people sit around and talk to each other freely.
It's stilted.
It becomes
formal.
Stilted. Yeah.
So, the Fed governor term actually is 14 years. So I know you both approve of the president's choices of respected economists to serve as governors, but it is pretty unusual to have so much turnover, to have so many spots, and to have a president reshape the Fed. Richard, I just wonder if you can really bank on any continuity in monetary policy with such a different
Excuse me, teacher,
shape
can
of
I
a Fed.
interject
You may go.
something? The term runs for 14 years, but you don't get appointed for 14
That's
years.
right.
You get appointed for the number of years that remain in the term. So the term is a period.
Everyone's picking up each other's terms.
Right, and it
Yeah.
was set up that a term expires every 2 years. Because when you started, you had to not turn the whole board over every time you appointed one.
Still,
But
this
I
is
think
You're not
a
appointed
totally
chair
different.
for 14 years. I
Yeah,
think that's an
sure.
important thing, too.
Yeah.
I do think, for example, Randy Quarles, first-rate appointment. I mean, he came out of Davis Polk. He understands the sup and reg side. One of the best practicing lawyers in that area. And went in, by the way, married to Fed royalty because Hope Eccles is his wife in the private equity group he was in Utah. But I think, as Stan said earlier, the appointments so far have been quite good. The nominations have been quite good. I just wish the Senate would process them so you could have a full board. And that's up to the politicians. But I give this president credit for at least nominating good people for the Federal Reserve, apolitical people, hopefully.
So, Richard, can I ask you, I never served on a board with more than 5 members, as far as I can recall.
That's why it was so efficient.
And many people said we do just fine with 5.
Yeah, I think you did great. Yeah, you did.
It would mean there could only be 4 presidents on the voting side.
No, there's always 5 presidents on the voting side because the New York Fed gets.
No, that's now.
Yeah.
But if we went to a 5-person board,
we'd still be overwhelmed.
Huh?
The presidents would still be overwhelmed.
This is very technical.
Well, you wanted inside baseball, didn't you?
It's a very exciting group of people.
Stan, what do you think Chairman Powell's biggest challenge is going to be as he takes over this new term?
I think almost every chair or governor of a central bank anywhere finds himself facing a crisis within 2 or 3 years. And the big challenge will be, how does he do in his first serious crisis? There's a phenomenally good staff there. They're all the same. He knows how to use his staff more than almost anyone else. I mean, he milks the staff for everything they've got, and they've got a lot of information. I very rarely found that I had to call outside the Fed if I had a question. There was someone there who knew the treatment. So I think that's his major challenge. Other than that, it's we're moving now into a period where we're essentially where we would like to be. Inflation at 2%, full employment, over full employment. Now we've got to manage that.
Where do you see a crisis lurking?
Oh, listen, I have 2 things never to answer a question. When you say they should open up the economy and they should free up imports, tell me what they should going to produce for exports. So I don't have the foggiest. Suppose you'd announced that Chile would become an exporter of domestically grown salmon. They looked at you like you were nuts. I mean, these are things the private sector figures out, and they figure them out better than anybody like me can say. So don't answer that question because you don't know. And on the crises, they come from unexpected places. You have to know how crises have been handled. Jay has a considerable advantage in having been there for a large part of this crisis, of the last crisis. But you had better not expect that the next crisis will be the same as this one. The first crisis I was in was the Mexican crisis of 1994-5. We were summoned to a meeting when we discovered there was a crisis at 6 in the morning. And the then head of the IMF's Kamdasu said, "Gentlemen," and they were all gentlemen in those days, "Gentlemen, this is a crisis, and in a crisis you do not panic. Let us get down to work." And
those are the orders.
Those were the orders, and we got down to work. And don't think that there's something super special about this one, and you've got to do this, you've got to do that first. There is a procedure.
Well, Richard, you were sounding the alarms on housing pretty early inside the Fed.
Yeah, but we didn't really, none of us saw how deep and awful it was going to be. But again, Ben, now you weren't there, Stan, but I think he was channeling your wisdom in that. He taught Ben Bernanke.
PhD advisor, right?
But
Thesis
Ben,
advisor?
we huddled down. We all, again, rode together. We had different philosophical views about monetary policy, but at that point, we just had to be together. And we had video conference night after night after night for 18 months. But I think Stan's right. You never know where a black swan is going to appear. That's why it's called a black swan. And you just have to pull together to solve the crisis. I do think what they're doing now, I look at the policy now, the 2% intermediate term inflation target is very important, but they're roughly there. You can overshoot it for a while, you can undershoot it. We know that pressures are beginning to build a little bit, commodity cycle and on wages and salaries. It's not out of control. But we are long in the cycle. The record is 10 years, March of 91 to March of 2001. Presumably, there'll be some propellant behind this with the fiscal policy, that is the tax cuts, inducement for CapEx, and perhaps a better regulatory environment for private businesses than they had before. But at some point, the cycle turns. And from a risk management standpoint, I think the object here is to get as many nuts in the tree as you can. So get as many quarter-point increases without disturbing the system.
They're going too slow?
No, I think this is the pace that they've adopted. You're paring back the balance sheet. We established the principle of using the balance sheet. And you want to have the toolkit to help mitigate a downturn. That would be not a crisis, but it'd be a nice way to manage your way through this business cycle. Because at some point, the business cycle has not been conquered. God hasn't conquered the business cycle, and President Trump has not conquered the business cycle. So you have to have the tools in place. And lifting off the zero bound as they're doing, I think, as deliberately as they're doing, is the right policy to pursue. And I expect it to continue for quite a while if they can have the space to do it.
Stan, do you think this is going to be a tricky task in normalizing, raising interest rates now that we are starting to really see inflation take hold?
Well, I mean, seeing inflation taking hold when for the first time in how many years, I don't know, but a large number of years, we've actually got as high as 2%. I don't see inflation having taken hold, and if inflation is going to average 2%, it'll be above by a few percentage points from time to time, and that'll be.
You're not worried about it coming on fast?
I'm not worried about it now, but the question is, what decisions are they going to make when circumstances change? And you will have a pretty wise group of people there, assisted by a really very professional group of economists.
So they have the tools. What if we are turning in the business cycle and we go into recession?
Well, we've got a little bit of room to cut interest rates, and there's QE, which nobody likes, but which works. Well,
especially this guy.
No, I was against QE3, but it was just a judgment. I felt that we wanted to save our last bullet in our holster in case we did slip backwards. I didn't think it was necessary at that time, but I lost that argument, and I think wiser heads prevailed. But here's the point, which we're both underscoring. You've established that as a useful tool, and you can revert to it if you need to. You prefer not to, but they are paring back $360 billion a year in treasuries, $240 billion a year, and as they get to the full run rate this October in mortgage backs, that gives them some room to use the balance sheet if they have to. You prefer not to.
What do you think, Stan, about the idea of fiscal stimulus in the 9th year of an expansion?
Well, I was not opposed to some fiscal stimulus because I kept worrying about R-star. May I speak about R-star in polite company?
Sure.
You know, it was the real interest rate that people are estimating as being the equilibrium interest rate for the long term, the short-term interest rate that people are estimating as equilibrium is very close to zero. So in that sense, we don't have a lot of room. On the other hand, the term structure typically slopes up. Hasn't lately, but it typically does. And anything that typically happens is very likely to happen again. That's one of the reasons I couldn't really spend days and nights worrying about the Phillips curve not working. If you say, well, if there's a lot of pressure on the demand for labor, the price of labor goes up, that seems to me like about the best economics you can get. Yeah, it's demand and supply. It's true, and it's happening, but it's not happening at any rapid speed yet, and they can raise interest rates, and then if we do get into a recession, they can cut interest rates, and as I said, as Richard says, we could go, if we have to QE.
We've seen some volatility in the markets lately, since February. Do you think that that is because of the Fed or because of President Trump?
So just as we were getting, I have a colleague, some of my colleagues from Barclays in here, but Nick Howard heard me say this. Just before Christmas, I heard a term when I was visiting hedge fund and other money managers here in New York and in London, meta stability.
Meta.
And I turned to Nick Howard and said, this means we're on the verge of great volatility. I mean, look, we had a one-way street, and part of this was, in my view, we engineered this deliberately. Remember, the S&P bottomed at what I call the Book of Revelations number, 666, right? First week of March, 2009. And what we wanted to do was create a wealth effect. Clearly, when you drive the rate to zero, hammer down a yield curve so real rates are zero, it changes the way you can discount future cash flows, present value. So the rally was engineered. I think it worked very well.
You're one of the few people that admits that the Fed was trying to engineer a stock market rally.
Not so much that, as we were basically trying to create a wealth effect and hopefully get things started again. We were at rock bottom.
Listen, he's not known as a moderate, but he's giving you the moderate position, and you're taking the position of Richard Fischer. I'm not sure you should be doing that.
But I'm trying to be provocative.
No, but we had a one-way street for so long that I think it's healthy. Otherwise, you create a maldistribution of investment assets. And we were shoving things into a high-risk corner. Usually you pick up yield by moving out the yield curve. You can't do that. So instead, you're going to high-risk categories. And I'm not surprised this went on for so long. Meta stability, whatever that meant, was a key tip-off. It wasn't going to last. And I think this is returning to normal, in my view. And I think it's a healthy thing.
Is it healthy, Stan?
Yeah, I mean, you say that we didn't, I wasn't there, we didn't admit that we were trying to get stock prices up. Well, we were trying to get the prices of things that are reproducible up so that people would produce those things. And part of that hope was for housing, which didn't respond that quickly. That's typically where monetary policy works, and that took a long time. But I would say I wasn't there when Ben was managing it, but certainly as Janet was managing it, the process was managed very well. And this requires a lot of management of expectations. And there was Janet, as calm as you can be. I thought that Janet was superb in dealing with the public, dealing with the Congress, because she's tough as nails and she doesn't look it. So, you know, here comes this nice person walking along and you say something stupid and she says, well, that's not the way it works, Senator. And then she explains. And she does this with a nice smile and she speaks beautifully. That's great. That was wonderful management of expectations. But we knew, people like Richard and others knew, we had cut interest rates to as low as we thought then they could go. It turns out they can go a bit lower. And stock prices went up like heck. Well, if we were going to normalize interest rates, that relationship had to get restored to normal somewhere, at some point, when people were confident that we didn't need the very low interest rates and so forth. We're there now, and that switch in which the premium on the equity premium returns could be a difficult one. It was difficult. We were all sure we'd seen it early in February this year, and then it went away as quickly as it came. But, and we're getting somewhere there, but we still got a flat yield curve and it will eventually go up. But, and that could be a difficult period. But these are things which anybody who sort of looked at the underlying economics would know were going to happen. And they happen. You can't say they happen on schedule. So they happen at some point.
Including fiscal stimulus. We were hoping we'd get some help from the fiscal side and the regulatory side. You know, you have to give, I want to come back to Janet and Ben, you have to give them credit. We were the only players in town. We had no help from the other side, none. And this is a late package, late in the cycle. I'd rather have it in terms of its treatment of CapEx than not have it at all, but I wish we had it earlier, some variation. The counter to that is, of course, running up the debt and the borrowing schedule for the Treasury.
Right.
And that's a little conflict at a time, obviously, when the Fed's withdrawing from being a major purchaser of securities.
So how would you rate President Trump's economic policy so far, Richard?
I'm going to let Stan answer that question.
So let me just, I thought a little, with our star being so low, I sort of made a nuisance of myself by saying it's not only monetary policy that affects the interest rate, it's also fiscal policy. And we could do with some help from fiscal policy to get our star up. Namely, an expansionary fiscal policy would raise the equilibrium interest rate. They did it, and they did too much of it, I think, is the answer. But
the tax cuts, or?
Whatever the fiscal stimulus was, there was tax cuts, and there were a whole host of other things as well. There was too much of it, but having some of it, which I think is exactly what Richard just said, seems to me to have been a good idea. You know, and then there are the issues about who's getting the tax cuts and all that sort of stuff, which is more into political side of things. But I thought some of what we got was justified.
What about trade? Both of you, I would guess, would characterize yourselves as free traders.
Well, I was deputy USTR.
Right. You worked on a little thing called NAFTA.
And I did do the protocol negotiations for China's accession to the WTO, and I've gotten a kick out of the Secretary of Commerce almost using scatological terms to describe what Charlene Barshevsky and I did. But other than that, I'm putting it aside. And, you know, the steel industry, every president, Democrat or Republican, including, I was Bill Clinton's deputy trade rep. We used 232 and 301, Republican and Democrat. There's something about steel, even though the people that use steel to fabricate products is a multiple of maybe 20 over those that manufacture steel. But for some reason, that always appeals. I hate to see these measures being taken. And I believe that globalization is best procured and advanced through as much free trade as possible. Now, if people cheat, you have remedies. And I do think China has been taking advantage. But I really am a believer, even Winston Churchill, who wasn't a great minister until he became prime minister of the war, basically said, you know, let them dump into our markets. We will take the value added and profit from it. We do that here. If you really look at where the profits are, it's at the high value added end. So that advances our economy. We're a high value added economy. And I really am, my one great criticism, I may have many, but the strongest of this administration is I do not like protectionism. And it creates, again, a distortion in markets, in the real economy, and it also has inflationary influences, which I don't think are necessary.
So you don't buy the idea that it's just a negotiating art of the deal tactic to get more fair trade for American business?
I do think it's a negotiating tactic. He does, remember Ross Perot's term, gorilla dust? That's sort of the way this president seems to negotiate things, beating his chest and so on, and may be very effective. We'll see. Just a sidebar, I hope it's very effective in the case of the Koreas. And I'm perfectly willing to give him enormous credit for that if it works. But on trade, I think you have to be very, very careful because we all know the path that protectionism leads us down, and it's a destructive path.
Who has more to lose, US or China?
Stan?
He defers all the tough ones to you.
This is called batting cleanup.
I just want to get the same.
I don't know who has more to lose. China certainly has accumulated a considerable amount of economic gain from this period so far. Given how far they've got, whether they will accumulate more in the United States, I don't know. I mean, when you've got a non-zero sum game and both sides can gain, well, you don't have to spend a lot of time figuring out who wins more. I mean, politically, I can see people like you and me and Sarah discussing who won more. But all they want is to say, you're better off because I did this.
Exactly.
Right.
And
I do think autos, steel, these are short-term issues. The real issue with China is 5G, the new, and what's called the latency.
You must be on the board
internet.
of a telecom company.
Well, I am on the board of AT&T, but this is what this is all about. And there was a moment, by the way, in this administration, we had to put out the word that our government was going to deal with that and take it away from the private companies, Verizon, AT&T, and so on, which we know would not be the right solution. But you have a control freak in China and Xi Jinping. And they're moving, they don't have the infrastructure that we inherited here with copper wires, even fiber, and certainly, say, credit cards and so on. They're skipping an entire generation. So they're pressing this quite a bit, and they do steal intellectual property. My alma mater, Harvard, is the second most attacked target by 2 Red Army divisions. Probably MIT would be first. But we know what they do, and it's unfair playing. But that's the nature of the world we live in. And that's what this race is all about as far as I know. Who wins in cyberspace? And that'll determine who gets the best of the other team.
Stan, what do you think when you read some of the headlines every day on trade and the president's tactics and the potential for a trade war?
Well, I mean, I prefer people who give the impression that they're meek and mild. We don't have a president like that. And the danger is that he will actually believe some of the things that he says. Now, when he says trade wars are easy to win, well, yeah, maybe. But I don't believe that. And I think the amount of damage you can do, because you can go into the structure of trade and screw up every industry if you're really good at it. And I worry enormously about that. And I was not encouraged by the fact that here we are, there's a theory that we need to change the economy. What's the first thing we do? Tariffs. 1930, what's the first thing we do? Smoot-Hawley tariff. Didn't work. That gave us Keynesianism. So maybe something good will come out of this thing, because the tariff thing won't work unless at some point, and this seems to me entirely possible, the president will say, okay, I've done enough, and move on to saying, okay, we've got a new equilibrium. What you said, I think there certainly must be some element of this being tactics, if not all of it being tactics. And
because it's just too awful to think about if he goes through with it?
Well, it's not too awful because you have to think about it, but it's pretty miserable to think about living in that world after all the work that went on to not do that. I once listened to somebody who'd been around in Italy after World War II, and he said one of the reasons we were in favor of free trade was we knew the government couldn't manage an economy that had free trade. And we didn't want a government that would manage the economy. And that's because there's so much going on, and prices are changing, and everything like that is happening. And that's by and large good. And there are aspects of it occasionally that you need to correct. And yes, I worry about that. But I'm a little bit relieved about the fact that some of this is clearly bargaining tactics.
You know, they used to say about the music of the German composer Richard Wagner, his music's not as bad as it sounds. I'm hopeful that this president isn't as bad as he sounds.
That's a good one.
Thank you.
What would happen to the stock market if we saw an escalation of the trade tariffs, if we started to see some of the threats being implemented?
I'm not sure that, first of all, trade war is a nice banner headline, but it may be a war of words, it may be a negotiating tactic. And I'm also not sure that this correction that we experienced a little bit at the beginning of the year and then since then is attributable to the trade dialogue. So again, I think this market has sort of fallen on its own weight, and plus the rediscounting that takes place as rates come up, particularly the 10-year, which has gone from 136.6 after Brexit to where it is now, pushing 3, 290. I think that's more of an impact than the discussion about trade.
We do.
But
'Cause
it's a
nobody
nice
believes
excuse.
it.
It's very hard to find out why markets move the way they move day to day. And it's a nice excuse to point to. But clearly, if we went full bore on protectionism, it would, to me, reduce the efficiency of the economy. It would lead to a maldistribution of wealth, and it would be a negative as far as equity markets and other trading markets are concerned.
What does a 10-year at 3% tell you, Stan?
Well, it tells me we're on the way to what I think is a reasonable interest rate for an economy that is at full employment and with, I hope, and with a very large debt, government debt. I mean, our government debt is almost as large as it was at the end of World War II relative to GDP, and that is a pretty.
Is that going to be a problem for the markets?
Well, it's the same question you asked earlier. Do we have room to do things? And would we go out and do another fiscal expansion if we need one? We were clearly holding back on fiscal expansion in the Obama presidency because of the debt. And you spoke to people and they'd say, yes, we could do a fiscal expansion, but look at our debt. Well, now you have to look up there. And it's harder. And if there's a responsible government, it won't do it. So you're taking a tool away that should have been kept for another occasion.
Let me give you some numbers that just puts this in perspective. In 2007, we had $9 trillion in federal debt. The cost of carry was 4 3/4. In other words, that was the percentage paid on that $9 trillion. Now we have $20 trillion at the end of 2017. The cost of carry, 2 1/4. Do the numbers, they're almost the same. Well, that cost of carry is going up. And that's where the conflict occurs. We've levered the economy. This new tax package is adding $1 trillion more. We'll see if it gets a payback. But we have borrowed increasing amounts of money at very low rates, and rates are rising. And that sort of puts the acuity of this in perspective. It's going to be hard to do anything more because of that debt burden that we have. Those are big numbers.
So what? Are we going to see the return of bond vigilante?
If you go back to 4% plus, you're talking about interest payments that exceed $900 billion a year, almost $1 trillion a year. Big numbers. Just to give you something to worry about.
So do you worry that we're going to see rates spike, interest rates spike, as the debt picture becomes clearer?
Stan?
Richard, I think you just lost the toss of the coin. It's your turn.
I'm not sure spike, but again, we've moved really far. Think of that, 136.6, which according to the Bank of England is the lowest interest rate of the dominant currency key bond since Genoa and Venice 800 years ago when they issued the first 5-year paper. So that's how low we were, and now we've gone up to almost 3%. So is that spiking? It's been over a period of a year and a half. We'll see. But I don't see the risk right now of spiking. I just can see a continued movement upward, although again, we're very attractive. The foreign flows come and go, but we're relatively attractive to Spanish yields that are in the ones, Portuguese yields, Euro yields. So we'll see.
Still negative.
Markets equilibrate by moving money.
But by the way, you've just answered a question that I have asked frequently. There's a British saying of the 19th century, gold standard days. John Bull can stand anything, but he can't stand 2%.
That's right.
And I was never sure which side he couldn't stand, but according to you, it was
the low
clearly
side.
He couldn't stand being below 2%. And we've been there for a while, and so was the United Kingdom during this period. So there we are.
These are interesting times.
So we have 1 minute left, and we'll do a quick and dirty prediction from both of you guys.
Start with him.
Start with you, Stan, says Richard. Where are we going to be this time next year in the economy? What are we going to be talking about, and what sort of Fed policies are we going to be debating?
Well, let me throw something in that we haven't discussed at all. I think that the global political situation is getting significantly worse. And you have now what is becoming an almost open war between Israel and Iran, and that is no joke in that area of the world. And then we have the China versus the West, and we have the Russians. It's becoming a more and more complicated world. And what I don't know is how that's going to play out in economics. The Chinese are playing a very good game in trying to keep it away from their economy. But you know, these things bounce out of control. And you have to say to yourself, I don't know. You know, I sort of think about crises all the time. And I wonder, how can things go wrong? The last thing I imagined was that the United States would say, well, that structure that we put in place starting in 1944 isn't worth a damn. And there's a new economy, world economy for you. So I don't know. And I worry. It is that the world changes more than it should, is what worries me. And I don't want to be specific about that because there are a lot of potential sources of difficulty. And, you know, we stopped talking about the move of leadership from the United States to Asia, but it could happen. And that will bring us into a different world.
On that light note, Richard.
Well, I always concluded my speeches at the Fed to say, and now I'd be happy to avoid answering your questions. So I will avoid answering your question.
No predictions for us.
No, I think that
no
you can't.
Final
I
thought
hope
to
the
think
business
about.
cycle is extended. I hope we have time to, again, put enough nuts in the tree from a monetary policy standpoint to then use it to mitigate a downturn when it occurs. And I expect we're going to get a little more length into this expansion, hopefully. And it would be nice if we had this conference next year, or had the pleasure of sitting with Moses here next year, that we could be worrying about whether the cycle is going to continue or not.
God or Moses. Well, we hope to do that.
Can I just mention one thing?
Yes.
Whenever my wife is with me and I'm at a conference where somebody says, and where is the stock market going to be next year? She manages to interject, he's not very good at that.
I didn't ask you where the stock market was going to be. We'll leave it there, gentlemen. Thank you.
Thank you all.
Thank you very much. And we'll be back.